Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below.
Okay, so breaking down Section 1231 into the last category, which is Section 1250, and that relates to real property assets. Okay, so when I say real property, I'm talking about real estate, right? We're talking about land and any buildings or structures that are built on that land. But again, this needs to be used in a trade or business. So we're thinking about take-back hotels and we're thinking about the hotel itself. All right, we're also thinking about the land that this building or structure sits on. What we're not talking about is buildings that are used for personal use or investment use. These are buildings that are used in a trade or business. Okay, so again, when you're thinking about Section 1250, we're thinking about the IRS coming back for its money, right? They're recapturing ordinary income. But what is it that they're recapturing? So when it comes to Section 1250, there are slight differences in the rules for recognizing gain if this is a corporation versus if this is an individual. So let's start by focusing on Section 1250 for corporations. So Section 1250, assuming this is a corporation, will be similar to Section 1245 in that we're going to be focused on depreciation. All right, so we're focused on accumulated depreciation, but this is a little bit different from Section 1245 in that we're focused on the recapture of the portion of depreciation taken on real property that is in excess of straight line depreciation. So Section 291 is technically what we're focused on for C corporations. Is that something you absolutely need to memorize? No, it is not. But it is just something to be mindful of, and ultimately what you need to know is the conceptual questions and the calculation type questions that the exam might throw your way. So we know conceptually what Section 1250 is. What do we know about calculating gain for Section 1250 for corporations? Well, let's pull out our mental map. Step 1, again, we're going to calculate our gain. And this is the difference between the sales price and the net book value. Step 2, we're going to focus on our recapture, right? The IRS is going to take back its money. So what are we recognizing as ordinary income? This is a little different from Section 1245 in that we're recapturing 20% of the lesser of accumulated straight line depreciation and the total gain. So we're determining the total accumulated straight line depreciation, right? A little different from 1245 in that we're focused specifically on straight line depreciation, but we're also still comparing that depreciation to step 1, right? The gain that was calculated. But the point that's really different is that we're recognizing ordinary income as only 20% of the lesser of the two. Okay, so we've now recognized ordinary income. What happens to the remaining portion of this gain? Okay, so in step 3, the remaining portion of the gain will be recognized as Section 1231 gain. So what does that mean? Well, it would flow right to step 1 in our Section 1231 mental map, right? We would take that Section 1231 gain, and then we would apply the 5-year look-back rule to see if any recapture exists from 1231 losses within the previous 5 years. That amount would then also be reported as ordinary income. Okay, so anything in excess of that would then be recorded as a long-term capital gain. Okay, so I know this seems a little bit crazy, but don't get too overwhelmed. Let's just remember this comparison in these mental maps for the remaining portion. Okay, so when it comes to Section 1250 for corporations, the remaining portion after recognizing ordinary income would be a 1231 gain, all right? Rarely are you going to see this in a multiple choice question, but if they throw you a super detailed task-based simulation, don't be too surprised if you see something like this. So let's just remember this comparison for painting the picture in our minds. Okay, so diving right into it, Take Back Hotels, Inc. is an elected C corporation that acquired real property that is used in its trade or business in year 1. The property had an original cost of $200,000 and has total accumulated depreciation of $60,000. On January 1st, year 4, Take Back Hotels sold the asset for $280,000. So we want to know how they're going to recognize the gain from the sale in year 4. Okay, so thinking about the mental map that we just covered. So step 1, we need to determine what the gain is from the sale in year 4. Okay, so we sold the asset for $280,000. And we know that the net book value is $140,000, right? We had an original cost of $200,000, and it explicitly says that we had $60,000 in accumulated depreciation. So $140,000 is what our net book value is, which will give us a gain of another $140,000. So the question becomes, how are we going to recognize this gain? Okay, so in step 2, we now need to consider our recapture, right? The IRS is going to take back its money. And when we're dealing with Section 1250 corporations, this seems a little bit similar to Section 1245. We're taking the lesser of the gain recognized in step 1 or the accumulated depreciation. Only difference is we're taking 20% of the lesser of these two. So accumulated depreciation is $60,000. The gain is $140,000. Obviously, accumulated depreciation is less than the gain that is recognized in step 1. So we're going to go with the $60,000 amount, only we're not going to recognize the entire $60,000 amount as ordinary income. We're going to recognize 20% of it. Okay, so very similar again to Section 1245, only key difference is we're taking 20% of the lesser of the two when recognizing our recapture. Okay, so $12,000, which is 20% of the $60,000 amount, is what is getting recaptured and will therefore be recognized as ordinary income. So the remaining portion of this $140,000 amount is ultimately what is getting recognized as long-term capital gain. Okay, so that's how we calculate $128,000 as our long-term capital gain. So still talking about Section 1250, only now we're talking about Section 1250 for individual taxpayers, not corporations. So basically this is anybody who's filing their business as a sole proprietorship, which would be filed on Schedule C on the individual 1040 tax return. Okay, but more importantly, this is still dealing with real property. So any land or buildings. Okay, so pulling out that mental map for the calculation type questions that we might see. And this one is going to be a little bit different from what we needed to know for Section 1245 and Section 1250 for corporations. Okay, so in step 1, we're going to be calculating the Section 1231 gain. So what does that mean? Well, thinking back on Section 1231 gains, we know that any gains that are classified as Section 1231 is good for the taxpayer. So why is that? Because Section 1231 gains will be taxed at the lower long-term capital gain rates, not ordinary income rates. Okay, but again, in step 1, that gain amount that we calculated is not necessarily going to be the entire amount that is getting reported as the Section 1231 gain. Okay, so you might be thinking, right, obviously a portion of this is going to be recognized as ordinary income because the IRS is going to take back its money. Okay, so that's everything we've learned up to this point, but that is not the case for Section 1250 for individuals. So this is actually going to arguably be a little bit more advantageous for the taxpayer. Basically what the IRS is saying, yeah, we're going to come back and collect some money, but we're not going to tax you at the ordinary income rates. So there is technically no recapture for Section 1250 for individuals. But what we do have is this unrecaptured Section 1250 gain. And this gain is going to be calculated in step 2 within our mental map, which is now the lesser of the accumulated depreciation using the straight line method or the gain that is recognized in step 1. And what I want to point out to you is that this is a little bit different from Section 1245 in that we're not going to be taxing this amount at the ordinary rate. This is going to get slapped with a 25% rate at most. And another thing that I want to point out is that this is also a little bit different from Section 1250 for corporations in that we're not taking a percentage of this amount, right? Remember, for Section 1250 for corporations, this is going to recognize that recapture as 20% of the lesser of these two, right? So for Section 1250 for individuals, this is going to be 100% of the lesser of these two. And again, this is going to get slapped with the 25% rate for the unrecaptured Section 1250 gain. So you might be thinking, wow, that's actually a pretty good deal. Why wouldn't we want all of this to be apportioned to this step 2 unrecaptured Section 1250 gain? Well, at the end of the day, Section 1231 gains are going to fall under the long-term capital gain rates, which is still going to be a little bit less than this Section 1250 unrecaptured gain rate. Okay, so that could be anywhere from 0%, 15%, or 20%, whereas the unrecaptured gain rate is going to be 25%. Okay, so everything after we have recognized the unrecaptured Section 1250 gain is going to fall
to the remaining portion, which will be taxed as a Section 1231 gain, which is going to be taxed at the long-term capital gain rates. Okay, so now let's take a look at a Section 1250 example, assuming that the taxpayer is an individual. So here we say that Tyler is a sole proprietor, meaning he's simply going to file his business taxes on Schedule C. So Tyler acquired land that is classified as Section 1250. So we're assuming that Tyler used this asset in the ordinary course of his business. So the property had an original cost of $70,000 and accumulated depreciation of $21,000. On January 1st, year 4, Tyler sold the asset for $80,000. How will Tyler recognize the gain from the sale of the land in year 4? Okay, so step 1, we're going to calculate the Section 1231 gain from the sale. So what's the significance of that? Basically anything that is recognized as a gain from the sale of this real property, assuming that we're dealing with an individual, is potentially going to get recognized as Section 1231 gain, which means that it's going to get taxed as a long-term capital gain. But first, we need to recognize any Section 1250 gain that is unrecaptured. In other words, what portion of this is going to get hit with that 25% tax rate, which is a little bit higher than the capital gains rates. Okay, so this is going to get recognized as the lesser of any gain recognized on the sale of the Section 1250 asset or the accumulated depreciation that is taken on the asset. Okay, so here we know that accumulated depreciation was $21,000, which brings our book value down to $49,000, right? The original cost was $70,000 less the accumulated depreciation of $21,000. The sales price was $80,000, giving us a potential gain of $31,000. But again, the question becomes how much of this is going to get recognized as that Section 1231 gain, the long-term capital gain, which is good for the taxpayer. Okay, so as we said, the accumulated depreciation was $21,000. So that tells us that this is less than the gain that is realized in this step 1 calculation. Okay, so $21,000 is going to be recognized as the unrecaptured Section 1250 gain. Okay, there's no recapture for individuals. So we have this unrecaptured Section 1250 gain, which is going to get hit with that 25% tax rate. All right, but that means that any remaining portion is what is in fact going to get recognized as the Section 1231 gain, which is a long-term capital gain. Okay, so that's going to be the remaining portion of the $31,000. So $31,000 less the $21,000 gives us a Section 1231 long-term capital gain of $10,000.